Today we have an update on the stock analysis on Carvana stock. I did the stock analysis July 13th of 2025. Last year, the stock was at about $353 at that time. And the issue was, the thing that brought it to my attention, the stock went from about $4 or $5 all the way up to $353. Such a huge increase. Looking at the financials, it didn't make sense. So I posted the analysis to help warn you guys, stay away from the stock. This doesn't make sense. Something's fishy is going on. Then the stock went up to $480. Now it's back down 34% to $317 on the downside. And Carvana has been in the news a lot over the past year for all the wrong reasons. So we have accounting integrity issues. Many short sellers and research companies have put out reports claiming that they are not honest about their financials and their disclosures. There's a lot of class action lawsuits that have been filed on behalf of investors for falsifying the disclosures and providing false financial information. A lot of operational and regulatory issues. They have had dealerships that have been shut down or banned in many states, also fined in many states as well. So issues like not handing over permanent title of the vehicles that they're selling and a myriad of other issues involving those lawsuits. Also, insider activity with a lot of selling by the Garcia family, who also are primary owners of Drive Time. With a lot of selling, when that stock shot up, a lot of people are claiming that there's some pump and dump schemes going on with this family. Looking at the amount of shares that they've sold over the past year as this stock has kind of skyrocketed out of nowhere. So we're going to do a quick update at this analysis and give you what I believe the stock is worth right now and kind of compare it to what I saw in July now that we have the final 2025 financials that are issued. So right now, Carvana stock, $317. So I did my stock analysis around this time. Again, it's gone up to 480, back down 34% down to $317. I believe this will continue. Just my opinion on what I'm saying. So let's just get right into the numbers and do our analysis here. So revenues. Now I want you to notice some things. We had some decent growth, but they had a solid growth in 2025. Now, what does this mean if the investors don't trust the numbers? I think that's why we're seeing some of the stock price come down. People aren't trusting that they actually had a 48% increase this year, but we'll see how that plays out. So over the past 5 years, averaging 38% revenue growth. That's an amazing number, largely due to some of this recovery after this down year in 23. Gross profit, 5.3%, coming all the way up to 20.6. That is a solid increase. But of course, revenues seem to be increasing at a higher rate than gross profit. So let's look at this chart here. I like to look at this visual because I like the trend analysis. I like to see where the trend lines are. What is growing, and is it growing at the same pace or faster or slower than another number, and let's look at that relationship. So we see revenues are growing at a rate that's a lot faster than the gross margins. So revenue growth is good, but the quality of the revenue growth is not there. So as the revenues get higher, they are not able to push more cost to the customer because it's a very competitive environment when you're talking about used cars. So we see that gross margins are increasing, but nowhere near the rate of revenues, which means revenue growth is great, but the quality of those revenues are declining. So we don't like to see that. Let's look at profit quickly. So they were profitable in 23, 24, and 25. Again, great increase here in the profitability of the business. So even though that's happening, revenues are still, stock price is still coming down. So as we see, looking at the profit, we don't see consistency. We see a slight uptrend, but with this bad year here and then up year down, up again, we're not seeing consistent profit here, even though we see more consistency on the revenue side. So that's something to keep in mind as we go through the analysis. Debt to free cash flow. How much debt do you have on your books and how much cash flow are you generating, letting us know how fast can you pay off the debt if you were to get in trouble. So, of course, these is horrible because it's negative. They have zero cash flow or negative cash flow. So they really aren't able to pay off these debts unless they are taking on more debt or selling shares, which we will take a look at in a second. So we see now over the past couple of years, they've got into a pretty solid leverage position. So on average, they're not good, but right now, 0.5, they have double the cash flow as debt. They paid off a lot of debt this year. So, or the debt balance came down a lot this year, I'll say that. So that's a good sign. So that's probably the most positive thing we've seen so far, looking at their revenues, profit margins, and now debt. We don't have a dividend, so let's look at shares outstanding. We want shares to trend downward. We want companies to generate cash flow, buy shares, and we want that share count to come down. We don't want to be diluted. We want our shares to become more valuable as the company takes more shares off the table with buybacks. And we see that's not what's happening here. This company is selling shares every year. Now, it does make sense for them to do that because they weren't generating a cash flow. So where is the cash going to come from? They have to sell shares or take on more debt. That's the only way they can keep the doors open. So we see that. So this is not a great sign, but it's not the most horrible sign because we have two things going on. One, they don't have cash flow yet as they're an earlier stage business. I wouldn't say early stage, but earlier stage business. And then the stock price was so high. So it could make sense for them to sell shares when the stock price is overvalued. That way they can bring in money to the company, use it for operations, and hopefully management will generate more value for the business when they reinvest that money that they're bringing in. So this isn't always a bad thing. Again, overvalued in newer company, but we see that this is not a sign of a quality stock or quality business if the shares are going up consistently every year. So right now, this is, I would say I'm neutral on this, given their position in the company, but it's not positive. So debt to free cash flow is the only positive that we've seen so far. Now let's look at economic value added. It takes capital to put into your business to generate a return. What does it cost you to hold that capital? That's what we're looking at. What does it cost to hold that capital, and compare that capital to the return that you're getting? Are we becoming are we growing in economic viability as an entity year after year? So looking at the 5-year average, they are not doing that. The return on the capital over the past 5 years, they're averaging 0.12. Now you'll see some of these metrics. Again, we're looking at 5 years. They only had 3 years of profitability. So we are including those negative years because we're long-term investors. So we want to make sure a company is performing well for the long term. Weighted average cost of capital. This increased since I did the analysis last time, I believe from 6 to 10%. They're losing value on average for the past 5 years. They're becoming less economically viable by a rate of 10% per year. So this is a very bad sign. So this is saying it costs them about 10% of the capital per year to keep the company going. And they've been only making 0.12 of a return on that capital. So it's costing them more to keep the doors open of the business. This is a horrible sign. We don't like to see that, especially if you're interested in quality stocks like I am. So with that considered, let's look at what I would consider to be the intrinsic value of this stock. Now, back in July, my intrinsic value was $85. Now, let's look at comparison of what we have now versus then. Right now, the estimated growth rate is 29%. With the economy being where it is right now, with a lot of uncertainty, if people are going to buy a car, they're more likely to buy a used car versus a new car. So this is why I believe the growth rate is up a bit. July, I said it was 17%, now estimated to be 29% per year over the next 5 years. It's a great growth rate. But let's look at the other factors. The discount rate. The cost of capital was at 6.8 this year, earlier this year, now 10.4. The cost of capital went up on average over the past year, so much so that we have a discount rate of 10. This is their hurdle rate that they need to earn in order to have a profit or become more economically viable as an entity, as we discussed before. I'm estimating 7 times free cash flow. I believe I was a bit more generous in July. I estimated 10 times free cash flow, but looking at it again, I'm thinking if I were to buy the stock right now, I would not expect to be able to sell that stock with the market cap more than 7 times the free cash flow amount. And we're at a free cash flow of 889 million this year. So with that said, I estimated the value to be $85 in July. Right now, I'm at $74. So a slight decrease before, pretty much in the same range, a little bit higher, but $81 to $66 is what I'm saying my range is. And the whole point of this analysis is to find quality companies and to make sure we are directionally accurate. The math gives me a number, but I want to be within range, right? The downside of the stock, or the downside risk of the stock, is too great to consider this stock beyond a trade. If you're trading momentum, totally different story. Any equity, any volatility, you can profit on. I understand that. When it comes to quality stocks, you want companies to give us more upside or have minimal downside risk. This is the whole point of the analysis. So I am not going to sit here and say, yeah, I did my analysis and I was right. I believe I was based on how I look at the numbers. However, we know that the stock can go up or down at any time for any reason. So a healthy, or I would say an accurate discount cash flow or fundamental analysis doesn't guarantee results, but it minimizes our downside risk. And that's what long-term quality investing is all about. You want quality businesses at quality prices, not necessarily deep discounts. We understand that you got to pay a premium for great businesses sometimes. And when our entry point needs to be at a position where our downside risk is limited. The downside risk is very great for this company. So this is my update. Let me know what you think in the comments. $74 is what this stock is worth. I hope to see you in the next video.